Good evening, everyone. I'd like to thank you all for being here. My name is Stanton Buckingham. I am the Development Coordinator for the UCR School of Business. I'd like to remind everyone this evening that we will be recording this session and that this is for educational purposes and should not be considered financial advice. While we all are looking forward to being able to once again gather in person, we are pleased to continue to offer programs featuring members of our UCR community. On behalf of the UCR Alumni Association and its board of directors, and in partnership with the UCR School of Business, welcome to tonight's presentation, Investing for Beginners. Now, at this time, I would like to invite our panelists to introduce themselves, tell a little bit about their involvement with UCR and their area of professional expertise. And why don't we start with our very own Professor Hellwig.
Thanks, Stanton. I'm a full professor in the School of Business and Finance area, and I hold the Anderson Chair in Finance. I've been here about 6 years. I've worked at some other state schools, and early in my career, I worked for the Federal Reserve Board. I'm also the advisor to our finance club, the Hylander Financial Group.
Thank you. And then why don't we have Professor Ritchie introduce yourself?
Hi, I'm Greg Ritchie. I'm an assistant professor of finance here at UC Riverside. I've been at UCR since 2017. Prior to that, I was at Cal State San Bernardino for about 20 years. I've been investing for about 30 years, and I'm currently the academic director of the Master of Finance program.
Thank you, Professor Ritchie. We also have Dennis Bine joining us tonight.
Thanks, Stanton. My name is Dennis Bine. I have a couple connections to UCR. I went there as an undergraduate and as an MBA student back in the late 80s, early 90s. Was fortunate enough to have a professor of mine who actually offered me a job while I was getting my MBA. So I'm probably much closer to retirement than I am starting my career, having never had a resume and never looked for a job. And so I've been an investment manager for the past 30 years or so. Portfolio manager and chief investment officer, been owned by lots of different organizations throughout the years. Started with a couple million, have had 20 billion, back down to about 5 billion after the GFC, back up to 20 billion, bought ourselves, sold ourselves. So it's been a long and kind of crazy road, but a pretty good connection having it all started there at UCR.
Thank you, Dennis. We're also pleased to have Randolph Kim joining us this evening.
Thanks, Danny. Hey, I'm Randolph Kim, also a double alum from UC Riverside. Got my undergrad in 2011 and then back for a Master of Finance in 2014. From there, I kind of had a pretty storied route in finance, starting from private wealth management, kind of made my way into investment banking and then into a long short equity hedge fund. And now kind of find myself in a little niche spot in family offices doing private equity, real estate, and venture capital.
And finally, and last but not least, we have one of our students, Cindy Fabrizio, joining us.
Thank you, Stanton. I am a Master of Finance student. My name is Cindy Fabrizio. I also lead the meetings for the Hylander Student Investment Fund, where we manage over 130,000 investment portfolio for the School of Business. I am also a member of the Hylander Financial Group. I am also a graduate student financial analyst for Union Bank. We underwrite tax-exempt bonds, but yeah, that's me. Thank you.
Thank you all for introducing yourselves. Now, we did receive an overwhelming number of questions that people have written in. I'm going to do my best to work through many of the questions that we received. As you can see, we have a very diverse group of panelists who are going to give their insight to the questions that you have provided. And we're going to go ahead, we're just going to kick things off. I'm going to ask Professor Hellwig to kind of give a basic overview of just jargon or terms or things people may think of when they think of investing.
Okay, well, I could spend the entire hour talking about vocabulary, so let me try to limit to them to the more useful things, I think. So, this is a webinar on beginning investing. And so then I think it's important to be thinking about the jargon that goes with the vehicles that you invest with. So it used to be that people invested a lot through mutual funds, and these days they tend to go with ETFs or exchange traded funds. There are a lot of initials or acronyms in finance, so ETF is one of them. There are indexes that you should be familiar with, the S&P 500 being one of the most important ones, the Dow Jones Index. Smaller stocks are in the NASDAQ or the Russell 1000, Russell 2000, Russell 3000 indices. I think we've heard a lot of words that are just important recently, but not always importantly, not always. And one of those is SPAC. So it used to be that companies would join the list of publicly traded companies by doing an IPO, initial public offering. But these days, they often sort of come into the market through the back door, and that back door is called a special purpose acquisition corporation, or a SPAC, which is basically a company that's set up to acquire this company that's going to go public. I think another one that people want to pay attention to is the VIX. The VIX is a measure of the volatility. It's a forward-looking measure of the volatility of the stock market. So when you hear that the VIX is high, a lot of people say, oh, people are worried. I think two other words that are really important to pay attention to, and I'll just limit it to this unless somebody asks a specific one, but alpha and beta are important ones. So we often measure the risk of a stock with beta. That beta is a concept that comes from a model called the CAPM. And so beta measures the risk, and alpha is the extra return that you get. So you might have heard of a website called seekingalpha.com. It's because investors seek alpha because alpha is the extra return that you get for no risk. So you shouldn't get it, but sometimes you get lucky. Sometimes you're smart and you can find these really good stocks. And so people who are seeking alpha are looking for the undervalued stocks. And I could go on, but I think I'll send it back to Stanion at this point.
Thank you, Professor Hellwig. Professor Ritchie, is there a recommended minimal amount that someone should start with investing? And are there apps that you would recommend for investing, such as Robinhood or some of the others that are out there?
I don't necessarily believe that there's a minimum, but before you start investing, you should always make sure that you've met the prerequisites. And by prerequisites, I mean that you have a balanced budget, you pay off your credit card debt. Remember that investing is money that you're putting away not for next quarter's tuition or next summer's vacation. The longer that you can keep your money in investments, the better off that you'll do. And once you get started with the investing, before that, make sure you have an emergency fund, 3 to 6 months of emergency fund. Also, make sure that you understand what you're investing in. So once you understand what you're investing in, you're probably going to do the investing through your 401k or 403b, which are employer-sponsored retirement plans, or individual retirement accounts. Now, the minimum there, if you have a 401k, is what is going to be matched by your employer. If your employer is going to match 4 to 5% of your salary, if you put in 4 to 5% of your salary into your retirement fund, your employer matches it. If you put in nothing, they put in nothing, and your nothing is matched with nothing. So that would be a minimum right there. Now, in terms of apps, or basically, I don't use Robinhood. I try to stay away from my phone, but I would suggest some type of, we call like a discount. Now they're pretty much all online stock brokerage for a beginner. I've been with Schwab for about 30 years, but there's also E-Trade, Ameritrade. Actually, Schwab just acquired Ameritrade, so they're starting to consolidate just like where you see everywhere else. But yeah, something that you can start small, all right, and then start to build over time, especially as you get pay raises. So if you're putting 10% of your salary into your retirement fund while you are earning $50,000 a year, make sure that you're still putting 10% of your salary into your retirement fund when you're earning $80,000, $90,000, $100,000 a year. Don't keep flat with your investments over time.
Thank you, Professor Ritchie. Dennis, how do you identify a solid versus a risky investment, and are there resources that you would recommend for doing so?
Well, I think that the resources are the tougher part of the question because having done this for 30 years and being part of my little $20 billion team is part of a $600 billion organization. So the resources that I have at my disposal is pretty much any publicly available data in the globe. So I can access any piece of fundamental or technical data on any company in the world instantaneously. So I'm probably not the best person to answer that part of it. But the risky versus good, I think part of it comes down to probably things that have already been said. I mean, one, there's the alpha and the beta side of things, right? So there's a tremendous amount of risk in beta, and there can be risk in alpha too, right? So like professionally, I don't get paid for alpha, or I don't get paid for beta. I only get paid for alpha, right? So I'm not. To me, beta is almost the investor's choice, right? So I don't know if that makes sense or not. So if you're young, you can take a lot of beta risk because you've got time on your side. If you're older, you may not want to take a lot of beta risk, right? And that it kind of gets into the whole theory of when you're young, you probably want to be more heavily invested in stocks. When you're older, you do kind of more of a balanced 60-40 allocation or something like that. So figuring out that part of it is the biggest determinant of your overall risk, which is kind of the asset allocation decision. Then you get into the alpha side of things, which is if you look at, I think Professor Ritchie mentioned Schwab. I mean, Schwab, you can, and I'm sure every website has the same thing, but you can go on there and you can answer questions which will give you some sense for your risk aversion. How comfortable are you with taking risk? Are you willing to shoot for making 20% return and risk losing a certain return? Or are you more comfortable or only earning X because your downside will only be half of the other scenario? And so once you can figure out what your own risk aversion is, then you can figure out what risk is. Because what risk is to me as a 55-year-old who's nearing retirement is very different than it would be for my kids or for perhaps some of the people on this webinar.
Thank you, Dennis. I see a question from the audience, and we did receive this question from a number of people. Professor Hellwig, could you give your input on what you think of cryptocurrency?
Okay, well, so to a certain extent, a cryptocurrency is just a currency. And so when you ask, should I invest in that? To a certain extent, it's like asking, should I put my money into quarters or dimes or nickels? But that's really a naive way of thinking about it because there's more to it than that. But it still does work as a currency. And we are seeing that more and more places are taking it as a currency. So I think today I heard that you could, in some places, buy a house with a cryptocurrency. But even if you were to put a lot of your savings into pennies, nickels, and dimes, it's still an investment. And that investment has a payoff that varies with inflation, for one thing. So when there's deflation, having a currency that doesn't have any specific return to it pays off. And when there's inflation, it gets eaten away. So one of the things that's really different about cryptocurrency compared to putting your money into dollar bills is that the way that the cryptocurrency is set up as a software product is that it has a limited amount of it. So there's just so much Bitcoin, Ethereum, or other cryptocurrencies that are going to be mined. So they're mined with some pretty complex computer programming. And so there are companies like Riot Blockchain that go searching for this cryptocurrency. They use an enormous amount of electricity to find it, but that's what they do. And because it's hard to find additional cryptocurrency, there's a limited supply. And anything that has a limited supply is more likely to go up in value. Whereas pennies, nickels, and dimes are not limited. The US government can print them like crazy. And the dollar bills in particular, what they print like crazy. So if you're concerned that the country that you live in is going to have a lot of inflation, then a cryptocurrency would be a good hedge against that. And we're lucky in the United States that we've had the rule of law and property rights and a pretty safe place to live for a long time. So None of us have ever been the victim of genocide. We have not lived through wars. But if you were somebody in a country where you're being persecuted and you need to take all of your belongings and get on a boat and get out, or climb through a mountain pass to get out, you'd rather not be carrying 10 pounds of gold or some paper currency that's going to be worthless when you get to the other side. So cryptocurrency is also a good, safe place to store your value if you're concerned that it might be lost. And I suppose to a certain extent, it might even be safe for us in a very safe country in the sense that there is identity theft. Somebody could hack into your bank account, and blockchain is known for being very secure. So it's, to a certain extent, it's like investing in nickels and dimes and quarters, because it's a currency. It's a currency that could gain a lot more value than other currencies have in the past, and it could gain more because of the scarcity value. And it also has that portability and safety element to it. On the other hand, it could also be, because there isn't any government behind it, it could also be a place where criminals hang out. It could be a great way to do money laundering, which I hope none of you are planning on doing. And so it may not be something that a government wants to actually encourage. On the other hand, the Chinese government is now planning on creating its own cryptocurrency. So why have Bitcoin when you can have the Chinese version of Bitcoin that the government stands behind? So it doesn't have to be, cryptos don't have to be something that don't have the government behind them. But if they do have the government behind them, I think the inflation hedge thing might be kind of limiting. And obviously it's been a tremendous investment lately, but it doesn't always have to be. And there have definitely been some ups and downs. So if you say from the beginning of the invention of cryptocurrency to now, or particularly for Bitcoin, it's just tremendous value. But if you bought it, a few years ago, you could have had a good ride downward for a while. And knowing when to get out and how long it's going to keep going up, that makes it a very risky investment.
Thank you, Professor Hellwig. Cindy, is there an app or a way that individuals can make informed decisions about where they invest or divest, particularly being informed about a company's involvement in oil or animal testing or anti-union?
Thank you, Stanian. So Dr. Ritchie mentioned know what you're investing in, and that is very applicable to what we do when we invest in HSIF, or when we do research. We're not institutional investors, so we don't have the same resources that an institutional bank or an institutional company would have. And so we rely on, if you have a brokerage account with Fidelity, TD Ameritrade, or Schwab, those are good sources to get information reports, what other analysts are saying. Also, if you are a UCR student, you have access to the UCR library, and you have free access to CapIQ. You can find financial statements there. I would, lastly, I would recommend, if you're looking more into what the company is doing, and it's something I can't recommend enough for people to do, is read the financial statements on the company. Listen to their earnings. Companies will tell you what are they doing, what are their plans on the company during their earnings calls. Professor Hellwig mentioned Seeking Alpha. That's a website that posts transcripts for free. Anybody can access them from their earnings calls. Yeah, those are the resources that I could recommend people to use.
Thank you, Cindy. Randolph, what are some alternative resources, free or low cost ways for people to get information or to help retail investors in making decisions?
I think Cindy covered a lot of good things. Additionally, I'd say the SEC Edgar has a wealth of information as well. That's where you can find a lot of filings, and not just the earnings, but everything else like prospectus, any other updates. So that's a very useful website to definitely access. Another little actually interesting thing that I found by accident was, so I bank with Wells Fargo for some of my accounts, and I have an IRA there. And I actually realized when I used to have Wells Fargo as a prime brokerage, the exact same reports that I get are actually on the retail side. And they have some pretty good consumer analysts there. So you can actually go into the research portal in any of your trading platforms and actually see the different types of research. I know some places have like Credit Suisse and just kind of various different banks. So those are also nice free research reports that people like us on the buy side also get.
Thank you, Randolph. Professor Ritchie, what is the average time for individuals to wait for a return on investment? Not including overnight successes, of course.
Well, my little philosophy hasn't changed in the last 30 years or so, but I have a little quote that I like to say: time in the market beats timing the market. And I don't take, I mean, I look at the stock market every day, although during summer break, sometimes I cannot look at it for a week or two, but I pay attention to everything that I put in the market. I don't plan on touching it within 10 to 15 years. I mean, how's the market going to be a year from today? I mean, I hope higher, but we've done pretty darn well. I think, you know, the S&P 500 closed at an all-time high just yesterday. Where will the market be 5 years from today? I don't really know. Where will the market be 10 years from today? I don't know. Where will the market be 30 to 40 years from today? It'll be a lot higher than what it is today, unless a comet hits the planet or something else going on. If you put money in the stock market in 1999, you were underwater in 2009. If you put money in the stock market in 1968, you were still underwater in 1982. If you put your money, and of course this wouldn't be any of us in here unless some of you guys are vampires, if you put your money in the stock market in 1929, in the fall when it crashed, hit the trough in 32, you didn't break even until 1954. So this is not trading, this is investing. For me, it's a very long-term perspective. But like what Dennis said, we have what we refer to as asset allocation, meaning that the portfolio that you do have when you're 25, 30, 40 years old is not the same portfolio that you have when you're 55, 60 years old. You need to be more conservative because you don't have time on your side. But I play the long game with investing.
Thank you. I wonder if any of our other panelists have differing or concurring or other information surrounding time of
I was going to
investment.
ask if I could add to that. Yeah. So I think what Greg has in mind, I think, is particularly good advice when you're have a well-diversified portfolio. And some people, when they start investing, they don't want to do that. Maybe they think they need to put too much money in to become diversified, although you could do that through an index fund. Right? But let's say that for some reason you only start off with like 5 stocks, even if they're an even amount in each one. If one of them does well, then after a while you might want to rebalance and take a little bit off the table just to become more diversified and to be a little bit safer. So in that case, then, you know, it might make sense if you've held it for only 6 months or a year, but it's gone up a lot. You might say, well, it's not likely to go up a whole lot very soon, so let me take some off the table and put into something else. So in that sense, I could see a shorter horizon. But yeah, if you're working with an index fund, then you need to have a long horizon, or you'll end up, the worst of all possible outcomes, buying high and selling low. Right. So when there's a downturn, you need to stick with it.
Yeah, and I think if I could add one thing to that as well, I think there's a big difference between kind of investing and trading. You know, so investing, I think, is kind of what Professor Ritchie was saying is, you know, kind of putting money in the market, leaving it there a long time. I can tell you personally, I mean, I do this professionally and personally, I have never sold anything in my life. I'm a big believer that if I buy, it will be worth more later. And so I've had a couple things go bankrupt on me, but I have literally never sold a single investment that I've ever bought personally. do it professionally all the time, but professionally, I'm trying to add alpha, right? So I'm trading to incrementally add value on top of the market. So personally, I'm a much bigger fan, although I have had a trading portfolio. You know, at times, what I consider my investment account is just buy, accumulate. And that's really where you're going to amass wealth. And all the incremental getting out of things and getting into things, you know, if the market does 6, 7, 8% return, whatever you think it's going to do over the long run, if you're lucky, you're going to add 1 or 2% on top of that. If you're unlucky, you're going to lose 1 or 2% trying. But the vast majority of your return is going to be driven by what the market does. And so again, I'm a big believer kind of in that Jack Bogle mindset, which is keep things really cheap. By, you know, we're using one of the acronyms that was used earlier on ETFs, you know, buy ETFs, get broad exposure to the market. I can literally get, you know, exposure to pretty much every security, every equity security in the world just by holding 2 ETFs and get it, you know, for a few basis points. And so I think that's kind of a great way to go.
I can probably add another point to that on a different side. I've been asked, you know, some of these questions before, especially some in my circle. They ask, you know, what about like the levered ETFs, the 2X, the 3X, or the ARC funds, things like that. And I think what everyone kind of spoke to is, I think if you're looking at, you know, diversified, like Professor Hellwig mentioned, I think those are good buys. But when you're talking about like, I don't know, some of these levered funds, like they work well in directional markets, but mathematically in a sideways market, they start to decay and go towards zero, which is why they always reverse split. So things like that, I think you want to be careful of. And that's not something you want to keep buying when the price dips, because you need to understand how the price mechanic is working out. Otherwise, you can really get hosed.
Thank you all for your responses. While we're on this topic of time with investment, is there a time that shareholders can expect to receive a percentage of profit from their holdings? Is that something that they can expect after a certain number of time? And maybe Randolph, you could jump in with this one.
If it's just talking pure equities, I think it's hard to give an actual guaranteed figure since markets are always moving. If you have some kind of fixed income asset, maybe such as like an income or mortgage type of fund, sure, there's get fixed dividends, things like that. Otherwise, you could, if you're doing like an ETF, obviously like SPY, you can expect to earn what it's done historically, probably. Although that's never guaranteed as well. Like things like COVID back in last March happened, where you could have significant drawdowns. I think it was like 35%. So it's hard to say you will get a guaranteed return, but if you do kind of do your research, kind of figure out, what themes or what kind of tailwinds you can stack, that we can stack odds in your favor, I think that'll give you a better odds than not.
Thank you. Cindy, I had a question from the audience. Any thoughts on managing student debt versus investing?
Yes, definitely pay your debts. I would say I had a professor gave us a really good recommendation, and is if you're a student and you're young and you start putting money away, that extra money that it's probably going to go somewhere, I don't know, towards coffee, or I don't know, something unnecessary that you don't need, but you put it into investing, and then you invest it, you don't touch it, you'll see the returns, really high returns eventually, years later. And so and that is true. So definitely, if you have a student debt, I personally have student debt, I have to pay it, but there's always room, that extra money that I could use to something unnecessary, I will use it towards investing. Yeah, that's the best I could recommend.
Stanley, if I could add something to that, I think you want to look at student debt like you really should look at any kind of debt you might incur over your lifetime, which is think of it as an alternative, as an alternative return. So if your student debt, I'm not saying it is, but if your student debt, is at a 2% interest rate, then you need to make your minimum payments, but 2%, your alternative cost or the alternative return that you might earn could be significantly better than that. Now, if you're paying 6%, let's say, a 6% guaranteed, kind of fixed return is a fabulous return. And so there's no way with certainty in an investment portfolio you're going to do better than 6% guaranteed. So the best return that you can make for yourself is to actually pay off your debt. And that'll be true whether you're paying off student debt. And the same is going to be true later on in life when you're thinking about buying a house. You're going to have to look at the after-tax cost of carrying that debt, and you're going to make decisions. Do I like my interest rate? Am I better off carrying my mortgage that is at 3.5% or 4% and is tax deductible, and taking that money and investing it elsewhere because after tax I can incur a little bit of risk and earn a better return? Or is my mortgage at a certain rate that I'm better off just paying that off because that's a better return with certainty that I can get my investment side of my portfolio?
Thank you. Professor Hellwig, could you define index fund? It seems we're getting a number of questions about some of the terms that are being thrown out. So maybe you can jump back in and just share what an index fund is and maybe some of the other terms we're utilizing.
Okay, so I think there are three baskets of stocks that we hear a lot about. The Dow Jones Industrials is a group of 30 stocks. And obviously, they're mostly industrial companies as opposed to financial or transportation, but they're just large companies in the US, and their stocks were followed as a group. So in order to be diversified, we typically would say you need to have at least 10 stocks, 30 would be better. And so the Dow Jones Group is a diversified basket of stocks, but it's only 30, so it's not completely representative of the whole US economy. So if you want to get a broader index, a broader group of stocks that you can invest in, the S&P 500 is an index that is got 500 stocks in it. And I think Dennis, mentioned, maybe it was Randolph, mentioned the SPY. So SPY is the exchange traded fund. It's a lot like a mutual fund, and it invests in the S&P 500. So if you don't have the money to buy 500 shares of these 500 stocks, you could buy the SPY index fund and get a slice of all 500 of them. Okay, and then the NASDAQ is another group of companies, and I think you might have heard about the QQQ, which is, I guess, the NASDAQ 100, the 100 largest. And the NASDAQ tends to have more tech companies in the index and a little bit, in general, slightly smaller companies. And then the Russell 1000, 2000, and 3000, the Russell 1000 is going to be middle market to smaller companies. There are about 7,000 stocks in the US that you can invest in. And so when we talk about the S&P 500, it's the 500 mostly largest companies out there. So an index fund is a diversified fund to invest in. We recommend these days investing through an ETF because it's better for tax reasons. And so the SPY ETF, any number of other index funds will have you diversified and give you exposure to the stock market. So I tried not to use too much jargon in there. If I did, feel free to ask another question.
No, thank you for defining some of those terms for everyone. So Professor Ritchie, only 26% of stocks have been able to outperform the S&P. Is there alternative solutions to diversification without buying ETFs or mutual funds, such as picking your own stocks?
Well, you can pick your own stocks, but that's very active investing. In fact, the S&P 500, you don't want to talk about how many stocks outperform the S&P 500. I don't understand what that means, but the S&P 500, you always assume you have a portfolio, okay? And there's what we call active portfolios, and then the S&P 500 index fund, either through a mutual fund or an exchange traded fund, that's a passive fund. meaning you're not trying to beat the market, you're just trying to match the market. And in any given year, the S&P 500 index outperforms anywhere from what I read, 70 to 85% of all actively managed funds. And of course, there are some funds that can outperform the S&P 500 in a given year, and usually Morningstar, which is a firm that rates mutual funds from 1 to 5 stars, Morningstar will give those funds a 5-star rating. Secondly, though, you have to figure out, well, did they take more risk to beat the S&P 500? Because you can take a higher risk and earn a higher rate of return than the S&P 500. So you got to be really careful there when you're comparing apples to oranges. Also, if you're saying, hey, well, there's 26 stocks that I don't know where that came from right there. But if there's 26 stocks that outperform the S&P 500, are those the top 26 among the 500, or they're in the S&P 500? But it could be different this year from next year, right? So we always got to be really careful there with that.
Yeah, if I could add one thing to that, actually, I think you were saying, Stanley, that it was 26% of the stocks, outperformed the S&P 500. That really shouldn't be that much of a surprise. Returns are skewed, meaning, a stock, if you take 2 stocks at $100, one can go down to 0, the other one can go up to 1,000, right? So you can have a 10-fold return. And if you have that, you take a stock like Tesla, a large company that's gone up exponentially seemingly over the last year, and has done, amazing things for indices. I think pretty much any year going back historically, you can always attribute the success of any index, whether it be the S&P 500 or the Russell 1000 or the QQQ or the NASDAQ 100, to a handful of stocks. And again, that's just because of the the skewness and return distributions. That's all. And so I think I was going to say the challenge is if you're going to do the actively managed thing, is to try to find those, right? It's not that there's not great winners out there. It's I don't want to say it's a roll of the dice, but it's doing your research and trying to figure out, can you find, it's not a needle in a haystack, but can you find that 1 in 4 stock that outperforms? Or you want to do, which is kind of the whole idea of, most active managers underperforming after fees, which is just say, hey, look, I'm just going to take that average return, get it at very little cost, rather than incur lots of costs trying to find those few and far between successes.
Thank you. And as a follow-up question, Dennis, as an investor with high risk tolerance, how much of my portfolio should I dedicate to riskier investments such as crypto or squeezes such as GameStop?
Well, crypto, I'm going to defer on, because I'm not sure that I see it as an investment. I think it can, I think it might have a place. To me, investments are things that inherently generate some kind of revenue, right? So I'm participating in some kind of revenue. I'm not sure what I'm getting with crypto. It doesn't mean it won't go up in value. Heck, if I'd bought it at 5,000 or 10,000 or 20,000, I would have made a lot of money. But I'm not sure why I'm making it. It's just a scarcity argument. I wouldn't invest in gold. I wouldn't invest in silver as far as kind of earning a total return. It might be, again, a good safe haven for my assets, but it's not an investment to me, right? Investment is me buying part of it, and part of it's because I'm a public equities guy. So or even if I was a private equity guy, but I'm investing in a business that is inherently generating some kind of wealth, and I want to participate in that wealth creation. So I think that's a big part of it. The names like GameStops and things like that, I think you got to be careful on any of those things, right? I mean, I think there's a lot of people on the institutional side that took a lot of offense to what people were doing, trying to manipulate a stock like GameStop and trying to force a lot of big hedge funds into some severe pain. But then again, hedge funds kind of squeeze little investors all the time, and they continue to short stocks and put selling pressure on stocks, and they bleed little guys dry all the time. So I'm a big believer in buyer beware, right? If you want to jump in, I personally, I'll tell you what we did professionally. We shorted GameStop, but we shorted it at kind of on the way down. Once we saw what was evident, if you had large positions in something like GameStop, you can get squeezed out of the game, right? So meaning somebody can run that stock up, and then you have margin calls, and you get kind of run out the door with your tail between your leg. If you take a very small position, you're actually kind of betting that this is a temporary thing. So we shorted it at a pretty lofty price, and then when it came back down, we covered that. I would be hesitant though to buy a GameStop relying on individual investors trying to manipulate the markets, which is essentially what they were trying to do, right? We kind of took the counter side of that. Again, if I'm going to buy a stock, I'm buying it based upon the fundamentals, not on some little game that a group of investors are going to try to play.
Thank you, Dennis. Professor Hellwig, what is a Roth IRA, and is it ever too late to invest in one versus a standard tax-deductible IRA?
So the Roth IRA gives you an advantage by taxing you much later in life, whereas the standard IRA gives you a tax advantage when you do it. Particularly, these things are designed by Congress to help people save money, and they are also designed to be more helpful to the middle class than people with less money than that. So they both have a cap on it. But let's say that you made $100,000 a year and you want to save through one of these IRAs. If you put it in traditional one, you would get a tax break for putting it in now. Later on, when you take it out, say 20 years, 30 years from now, when you're retiring, then you pay taxes on the earnings. With a Roth IRA, you're going to take after-tax money. So you're paying all your taxes now, and then you open this IRA and you invest. And then 20, 30 years from now, when you take it out, you don't pay any taxes on the earnings. So if you have a very long horizon, then the Roth IRA has a giant advantage that there's no taxes on the earnings. Whereas if it's a short-term one and you want to have a tax break now, then a traditional IRA might be better. They both have the tax part of it. Both have limits on the income, but you can get into a Roth IRA through the back door. So you can always open a traditional one without getting a tax break if you really have fairly high income. And then once you have that, you can convert it to a Roth IRA. So it's a really good deal, and maybe Congress will change their mind and take away the advantage of a Roth IRA. But for right now, if you got a halfway decent horizon, you should be going with the Roth IRA.
If I could add something else to that, Stanley, I think one of the big decisions you have to make between a traditional or Roth IRA comes down to tax rates. So a lot of times early on in your life, if your income isn't that high, the Roth IRA can be particularly attractive because you're kind of bearing the tax brunt then. So if you're making $50,000 or $60,000 and you have a marginal tax rate of 22% or something, or 24%, whatever it is now, or maybe even less than that, that's the tax that you're absorbing now. And maybe later on in life, when you're established and you're making a tremendous amount of money, even in retirement, your tax rate could be higher than that. So you can decide which time is better to absorb the tax hit, now or later. The other thing is not just your income, but now it's kind of tax policy. So if you look at the way the tax programs might go in the U.S., tax rates historically might actually be pretty low relative to where they might be going forward. In which case, I have both. I've done a little bit of personal hedging with mine. So I have money in traditional IRAs and in Roth IRAs kind of as that hedge, because wasn't exactly sure where tax rates were going to go or where my income levels were going to go. So over the years, I've used both of them.
And Stanyan, could I add something to that too, since this is like an introduction to investing seminar? Just remember that an IRA, Roth or traditional, is not an investment itself. It's an account that you put investments into. So when you open up an IRA through your broker, make sure you figure out where you're going to invest your funds that you put into the IRA. I think that's a separate and distinct choice. After you've decided to open up a traditional IRA or a Roth IRA, well, where are you going to invest it? And I think that's a big question there. Right. People have IRAs, people have 401ks, they don't know where it's invested. And I think that's something to pay attention to. And earlier talking about S&P 500 ETFs, maybe that's a good place to start.
Thank you. Dennis, thoughts on Jack Bogle and his financial philosophies?
Well, I guess since I mentioned him earlier, so essentially, it comes down, again, it goes back to, I think, one of the initial terms that was used. It's kind of alpha and beta, right? So the Jack Bogle mindset is give you exposure to asset classes, kind of get the beta. So you're getting the beta in the US stock market, you're getting the beta in a global stock market, you're getting kind of we'll call it the beta of a fixed income market, but you're basically getting asset class exposure. And with the mindset that, investing is kind of a zero-sum game. So, you have winners and losers. I mean, it's not like Vegas, right? With Vegas, the house wins, right? So everybody loses on average. In investing, there's, I guess the closest to the casino is all of the brokers, right? So they're all getting their commissions. So you have prime brokers that might make fees, you have brokers that are making commissions. So all this little bit of money coming out, and then collectively the sum of all the other investors have to be kind of the market return less all of those fees. So Jack Bogle essentially said, look, why am I trying to succeed when I know that 75, 80% of the investors out there will fail? What I'm going to do is I'm going to try to keep these fees and costs as low as possible. And if I can give you kind of an index return, so if Vanguard, which is the firm that Jack Bogle started, if he wants to give you the S&P 500, he will try to give you the S&P 500 net of as small of cost as possible. If he can deliver that, and you put his, Vanguard, S&P 500 index fund into a manager database of all of the managers out there that are trying to actively beat the S&P 500, you'll consistently see his numbers over 5 and 10 year periods of time being in the, in the top quartile or in the top quintile. And so the idea is just to deliver returns, deliver them as cheaply as possible. And I think they're particularly suited for people that have that kind of that long run investment mentality as opposed to that kind of that trading and that alpha mentality.
Daniel, can I add to that as well?
Yeah, of course.
So we haven't said that much about expenses, but that's certainly an important thing to be thinking about when you're investing. In particular, a lot of people in the US put a good chunk of their wealth into real estate, into the house that they live in. And you can think of that as an investment, but it has very, very high transaction costs to it. Certainly, if you're not going to live in it, it's not your primary residence, and you buy it thinking it's going to have a good value later on. Or if you want to really take on some risk, buy an empty lot and say in Palmdale and hope that it's worth a lot later. Regardless of whether it's a good gross return or not, it has very, very high expenses to it. And then there's some other ones that have lower expenses, but they still do. So crypto is another one. If you want to trade crypto, you could do it through this company called Coinbase, but you would be paying fairly high transaction fees. Whereas if you trade stocks, particularly big stocks like those in the S&P 500, you can do those with very, very small expenses. And then if you go into a diversified fund such as SPY, then you can really keep the costs of trading or investing down. And so that obviously helps you return quite a bit. Thanks.
Thank you. And then we have a question from the audience. Should I be concerned with inflation, especially in light of the stimulus package during COVID? And I'll open that up to all panelists.
Well, the Fed is going to report on inflation tomorrow. So that's the thing that's, I mean, again, I don't pay attention to how the stock market does on a daily basis, but that's besides earnings seasons kicking off this week, that's the big thing that's going to be affecting the market tomorrow.
I think it's a particularly big concern if you're investing in fixed income or bonds. The 10-year Treasury bond has a yield that's less than 2%, but inflation probably will be above 2%. I think actually for the past year it is above that. So if you, stocks have a better chance of beating inflation in the sense of getting a real return that's actually above inflation, whereas fixed income right now, it would be quite difficult to cover inflation.
And the Fed also mentioned that the inflation that they see is what they refer to as being transitory, so not sustained higher inflation. So again, I can't predict how this is going to go just from what I read.
Can I also add to that, Stanion, is that, you hear and read a lot about the concerns of the 10-year Treasury going up, keep going up, keep going up, and then the equities market keep going down or they become flat. But thinking back to pre-2020, the 10-year Treasury was above 2%. And while the 10-year treasury is high right now, it's not near 2%. So I don't think that should be a concern right now, inflation.
And then we have another one from the audience. How do you feel about NFTs?
So I should have mentioned NFTs when I talked about crypto, because they are also a blockchain product, right? So NFT stands for a non-fungible token. It's a blockchain way of investing in something fairly unique. And we saw an art auction where it was the art itself was being transferred through an NFT. You know, if you as a kid like to collect baseball cards, then you might like to do NFTs for baseball cards. I believe they're just coming out, or similar types of things. There's some music that you can buy. So it's like SPACs. It's another acronym that you need to learn if you want to keep up with what's hot. But I don't know if it's an investment the same way Dennis isn't sure that cryptocurrency is an investment.
Do you guys have any books that you would recommend for someone that's interested in investing or looking to learn more?
One of the first investment books that I ever read was probably, goodness gracious, 40 years ago, but it was called The Richest Man in Babylon. And it was written in the 1920s or 1930s. I didn't know it was a book about investing, but it's fictional. It takes place more than 2,500 years ago. But what I learned from it was basically saving 10% of what I earn is mine to keep. So it was taught through the a history book. Also, I like a book that they basically do it about every few years. There's a new edition. It's called A Random Walk Down Wall Street. So it kind of talks a little bit about the history of the stock market. The edition that I have is probably 10 to 15 years old. So I'm due to buy a new edition. But you could just go to Barnes and Noble and you could just kind of scan through the aisles and see one that, you know, some of them are very general, some of them are pretty specific.
Yeah, I can add some to that. I remember in one of my undergrad stock market intro classes, we had a few books we had to read, and it always comes to mind because it actually kind of opened my eyes a little more into what the markets are. Because before it, you know, just see charts and patterns and talking heads on TV, and that's all I knew. But some of the books were, interestingly enough, F Wall Street by Joe Ponzio kind of says you don't need to be some Wall Street hedge fund to be able to invest in markets and make money. There was another great old investor called Peter Lynch, kind of talks about different ways of investing, finding out who you are as an investor. And a third book that was also very good that talks more into a different type of research and more special situations and looking at different situations, corporate actions, was Stock Market Genius by Joel Greenblatt. So those are some of the three books that I had in undergrad that really kind of stuck out to me. And I'd probably recommend to beginning investors.
Yeah, I think, and even beyond textbooks, some of the, you know, the best things, I mean, I hate to, you know, say things like, but I'm sure I know there are, you know, investing for dummies, those kind of things, which, you know, has nothing to do with whether or not you're smart or dumb, but whether or not you kind of know all the terminology. So you get a lot of that, you know, understanding what an index fund, you get a lot of those foundational things out of the way. But I think, you know, even beyond kind of good investment textbooks that would really teach you how to find a good fundamental investment, a lot of the public research out there from, you know, the brokerage firms is actually really good. You know, I think I've been with Schwab as well, so I'll confess that. But you know, I get a newsletter every quarter. It's got great personal financial advice in it. It tells you things like start investing early. Here's what happens when you save early versus saving later. Here's the different vehicles you have available to you. It'll compare Roth IRAs versus traditional IRAs. It'll talk about diversification. It'll show you that although most people in the US think that the US stock market is king, if you go back pre-global financial crisis of 2008, actually international stocks were the winners by 7 or 8% for the early part of this millennium. And so it gives you things like that that I think are really good for beginning investors. I think some of the other things are great for finding good investments. but it isn't necessarily the most important thing to learn about kind of creating a financial plan and having success as an investor over the next, multiple decades.
Yeah, so I want to add, I think you can learn a lot from mistakes in investing. And one of the big mistakes for a lot of people was investing in a house between 2005 and 2008. And so Michael Lewis's The Big Short is a lot about the people who took a different point of view on that, who thought they were bad investments and went short on it. So I think that's a great book to be thinking about. Is this a bubble, or is this something that's a good long-term investment? And I think you could, probably someday somebody will write a similar book about cryptocurrencies. But also Michael Lewis is a very entertaining writer. He also, besides the Big Short, he also wrote the book Moneyball, which was turned into a movie about the Oakland A's. So he's just a very entertaining person to read.
I would love to add to that, Dr. Hellwig. Good thing that you brought up Michael Lewis, because when my first finance class in undergrad, I wasn't, very confident. I wasn't sure if I loved investing. And the first book that I think a professor said, if you're an investor, or if you're in finance, you need to have Liar's Poker from Michael Lewis. And I bought it, I read it, and I fell in love with it. And, I think that's one I would recommend too, Liar's Poker.
Thank you all. And as a final question, and I'd love to hear from each one of our panelists on this one. If you had $100,000 to invest, what would you do with it? And maybe we could start with Randolph.
Great question. I would probably, just for kind of make things a little easier, probably do ETFs. Maybe thematic, that kind of, where are things going. So some actually ETFs that I hold personally are like iBuy. That's actual like an ETF that holds consumer companies, or typically any company that makes 70% of its revenue from e-commerce or online. So things like that, where you can see where the market directions are going. I'd probably invest in things like that, SPY, QQQs to get tech exposure. Just keep it simple, as more of a buy and hold strategy.
Dennis, did you want to jump in next?
Yeah, so I'm gonna give you the most boring answer because it's definitely ETFs. But I'll actually, since I haven't mentioned earlier, I'll give you my rationale for it, which I think is also another important lesson, which is I tried, going back to that alpha and beta discussion, right? I'm paid professionally to try to generate alpha. So my ability to pick a good stock from a bad stock actually determines my salary and my bonus every year. The worst thing that I would want to do is double down on those ideas. First of all, I'm prohibited from an SEC perspective from investing in most things that I buy professionally. But I'm already employing that skill set, and that's determined my income. So the best hedge for me is really to buy the index, right? To buy that broad exposure to the market, because if my ideas are good professionally, I'll make a lot of money at work. If my ideas are bad, then at least my investment portfolio is doing well. So if you give me $100,000, I'm buying the VTI and I'm buying the VEU, which are two of the Vanguard index funds that give me exposure to every stock on a cap-weighted basis in the globe.
So I'll give a slightly different answer. I think there's a lot of entertainment value from picking stocks. So I think that I would put 95,000 into Spider or index ETF, and the other 5,000, I would pick like 5 stocks, $1,000 each, and see if I couldn't beat my SPY thing. Because what do I care if I have 95,000 or 100,000? It's about the same. So I feel comfortable losing 5,000, probably won't go to zero, and would feel really good no matter what happened. If I did better than the index, I feel like, oh, I know something about companies. And if I did worse, I'd say I've just proven that the way to go is a diversified portfolio. So I think really it's like, what do you feel comfortable losing? And if it's maybe 5,000 would be too much to lose, you feel like I really only want to try 500. That's okay too. But I do feel like, having an understanding of what the risk is and your ability to invest well, that's an experience that's worth something. So even if you lost it all, I think it's probably worth doing a little bit of that.
Okay, I guess I have to give a little bit of a different answer from everybody else, but it still deals with asset allocation and diversification. If I was just given $100,000 and to do something that I'm not entirely doing right now, I would probably put it into what we refer to as a life cycle fund. And a life cycle fund basically helps me get away from determining whether or not I'm taking too much risk or not enough risk. So a life cycle fund and Fidelity Investments, which basically is just not quite as large as Vanguard, but they have what we call these Fidelity Freedom Funds, and they have a target retirement date. And the asset allocation, meaning the percentage of your money that goes into stocks versus bonds versus cash, is determined by when you actually need to tap that money for retirement. So let's say, for example, if I were 25 years old, which I'm not, I might put that into a Fidelity Freedom 2050 fund, which would assume that I would be retiring in 30 years in the year 2050. Right now, that fund would look about 95% stocks and about 5% bonds and cash. But every few years, as you get relatively closer and closer and closer to retirement and have less time on your side, that fund would start to reallocate out of higher risk, higher return stocks into lower risk, lower return bonds and cash. So by the time that you retire, you're not taking too much risk for your age. So it's kind of like a fund it and forget it type of an investment. So they call them the Fidelity Freedom Funds. No, I do not work for Fidelity Investments.
For me, I have the Professor Ritchie's mentality. The long-term investing is, I think it works. It works for Warren Buffett. Why wouldn't it work for me? And so I would put it into a fund for sure, and make it a long-term investment target.
Well, thank you all for sharing your answers to that question. I'd like to thank all of our panelists for being here this evening and sharing your expertise and your insights. So Cindy, Randolph, Dennis, Professor Ritchie, Professor Hellwig, certainly appreciate you guys taking the time to share with us and share with our audience. I'd like to also thank the audience for being here this evening and participating in this wonderful event. I would encourage you to look out for future events that will be hosted by the Alumni Association. Two that are coming up is the Hylander Week of Service and the Women's Leadership Conference. You'll see the link here on your screen where you can find out more information regarding these two events.